What's going on, everyone? Charlie here. We're going to talk about U.S. listed equity options, a primer for hedge funds. We're going to take a look at this and go into a little bit of a strategy and a little bit of criteria behind some options, decision making that we see happen in the markets, and just a little bit of background in general. So, section 1, the options landscape for hedge funds. Are hedge funds making the most out of options opportunities? Overview. Hedge funds remain one of the most active users of both exchange-traded and OTC options, which is over-the-counter, particularly in the US, but some managers may still be missing the opportunity that these instruments can offer them. Equity-based investment strategies dominate hedge funds, which account for a large slice of the equity options market. Many funds focus on the liquid US equity markets and use single stock options, ETF, and index options to hedge risk. We can see here that the hedge funds make up 55% of the U.S. equity options volume in the United States. 9% came from Europe. Private wealth management, 21%. Proprietary accounts, 15%. Asset managers, 6%. And other, 4%. Now, covered put or call options have long been a fixture for the long or short equity manager, particularly in markets where there is a wide availability of single name contracts where there's liquidity. In Asia, where the choice of single name options remains very limited, managers are still reliant on over-the-counter contracts or simple volatility strategies, like what we see around earnings. The equity hedge fund can use index-based puts and calls cheaply to hedge upside or downside exposure. Managers have been able to simultaneously profit from both long and short positions using options. However, it is difficult to achieve consistent returns on the short side during an upward trending market, as call selling is not a set and forget strategy. Ain't that right, Zion Lion? There are more sophisticated defensive strategies, that was mean, that make regular use of options, like hedging tail risk. Hedge fund managers are highly cautious as a result of bad experiences in 2007 and 8. I wouldn't say they're highly cautious, but they're getting better at hiding shit. This is an article from the Options Clearing Corporation, by the way. Now, they need to reassure investors that the fund is braced for the next black or gray swan event. It has also been observed that the value of put options, and not just equity puts, exploded during episodes of high volatility, e.g. the credit crisis and the flash crash, leading more fund managers to explore options as an alternative to defensive cash and treasury bond holdings. So the sale of covered calls by hedge funds is favored during periods when fund managers are relatively neutral on the market. This generates premium income and mitigates the potential downside exposure of a long underlying position. It is vital that the fund's risk management team has a solid quantitative methodology, allowing them to access or assess the probability of short calls being assigned and the impact that the assignment might have on the fund's senior strategy. One of the biggest risks with a yield-based strategy is that the holder of the option decides to exercise it to capture the dividend. While the maximum profit and break even are fairly clear from a risk management perspective, the likelihood of the option being exercised is also highly quantifiable, with a delta of 0.95 or above being a good benchmark. The holder of an American-style call option can exercise that option at any stage prior to expiration, but most likely when the dividend is greater than the excess premium over intrinsic value. So in Europe, you can only exercise contracts on day of expiration. In America, not the case. Now, in a nutshell, puts become more expensive as dividend dates approach, basically. So, if that's the case, let's take a little break. How can we use what we just learned in a real-life example? Well, if you look at Stonko Tracker, Stonko Flacker, you see that we have 295,704 puts out of the money, and we know based on verification that it's very deep out of the money, all the way down to 0.5, 1, 2, 3, 4, 5, and so on strike price. These are deep out of the money. So if put premiums go up, As dividend dates approach, wouldn't that mean the holder of these would try and capture the dividend by exercising? In other words, is Wall Street betting on a dividend from GameStop around this time? Or are these just FTDs that are spread out in a 6-month cycle? Because I can guarantee you, as this approaches, this will go away magically on the 22nd of January. Or I'm sorry, the 24th, 3rd, 23rd. So could it be this or could it be that? I don't know. That's why we read shit, to try to figure it out. Now, volatility. Volatility-based strategies arguably make the most use of options, with implied volatility regarded as one of the most important components of options valuation. Think of implied volatility as your measurement of valuation of the underlying option contract. So if you see a stock at a 145 strike, for example, and the implied volatility is 600%, you know that mofo is super overvalued. It is too expensive. That is what IV tells you. Does that mean you can't make money on high IV stocks? Absolutely not. Everything's different. It's just, generally speaking, high IV equals overvalued. Low IV equals undervalued for options prices. Now, many hedge funds use options to speculate on the direction of implied volatility. Because implied volatility itself trades within a range that can be well defined via technical analysis, a fund can focus on the potential buying and selling points indicated via established price bands. Volatility trading is also popular with algorithmic hedge funds, which can focus on trading in favorable ranges while retaining a hedging capability. Volatility equals movement equals profits. Where do we see volatility in the market right now? Earnings. Where do hedge funds like to spend most of their time trading options? In stocks with liquidity. What stocks do we know of that have lots of liquidity, where they also sell calls all year long? AMC and GME. Now, what can we use with all this information? Whatever you want, man. Whatever you want to do. But seriously, yeah, I'm going to go jack my tits now.